What's up, Facebook? Ty Crandall with Credit Suite here. Today we're talking about peer-to-peer lending. We're going to dive in and talk a little bit more about a really cool way to get money for your business that's way easier than getting money for your business through banks and through alternative lenders. So look, it used to be back in the day, in the early 2000s, that your bank was the best place to go to get money. Then the 2006 economy crashed, and then we saw these fintech, these online lenders start lending money that made it a little bit easier than getting money from the big banks. So at first, years ago, we had to get money from the big banks. Bank of America, Wells Fargo. Steve, what's up? Thanks for coming in. And it was very difficult to get approved because we needed to have good cash flow and good tax returns and profits and good credit, and we needed to have good collateral. Then the economy crashed. And then what happened was alternative lenders in 2006 started to come in this space. And they said, wait a minute, we don't need all that stuff to give you money. We could find one strength for your business and give you money based on that one strength. Maybe it's your cash flow. Maybe it's your credit. Maybe it's your collateral. We're going to lend you money based on one strength, not all three. Then all of a sudden, this whole new world was created of alternative lenders that made it easier to get money than what we ever saw before at banks. Now, we're in a brand new place, and a new form of lending has come up in the last handful of years that's actually become even more popular, and it's known as peer-to-peer lending, and it's going to change how you and I borrow money indefinitely. So this is how peer-to-peer lending works. Peer-to-peer lending is where your peers, where people invest into privately owned companies. They give you money, but they're not giving you money in exchange for stock. They're not giving you money in exchange for equity. They're giving you money just like a bank would, expecting it to be paid back on a set term and a lower interest rate. So why is this so important? Because for the first time ever, we now have an effective way for individuals like you and I to invest in regular businesses. $50, $500, we can invest in other businesses and get a rate of return. And now that it's become easy because of something called peer-to-peer lending and these platforms that make it easier, they've now created a brand new way for us to get money that's even easier than the alternative lending that came around in 2006, and that's way easier than getting money from your bank, okay? So that being said, this is a really important thing that you need to know about because it's easier to get money than you're going to find with online fintech lenders. It's easier to get money by far than the big banks. Now, Gary says, how easy can we make it to get a peer-to-peer loan? It's pretty easy, and this is how easy it is. They're looking usually at your credit about 620 FICO score. And if you've got some consistent revenue, even one of these will work for a startup, and you've got average credit, there's a good chance that you're able to get approved. So unlike big banks that need good credit, you don't need good credit here. Unlike big banks that need collateral, you don't need collateral here. Unlike big banks that need years of tax returns and consistent revenue, you don't need that either. You need average credit and to prove that you're generating some cash flow and you can get approved. So today, I'm going to dive in and I'm going to decode what you need to know about peer-to-peer lending. Now, there's two options here. You can either lend to other money, to other borrowers, other business owners, and get a rate of return, or you can borrow. So remember, we're talking about private individuals like you and I that are actually investing money into your company. That's if you're the borrower. But you also might want to be the lender. You might be the one person that's contributing money to help other businesses and getting a rate of return. And let's be honest, this is probably going to work better for you than what's happening in the stock market right now. So let's jump in and talk more. So peer-to-peer lenders, here's what you need to know. We are talking about private individuals, your peers, lending money to other privately owned companies. Peer-to-peer, it's why we call it that. Now, the way that peer-to-peer lending works is we've got peer-to-peer lenders or platforms here. And these guys are just simply that. They're platforms. So, and we'll talk about startups here in just a second here, Gary, because one of these will work really well. So let's talk about crowdfunding as an example. When you think about crowdfunding platforms like Kickstarter, we know that Kickstarter is not lending you the money. They're not giving you the money. Kickstarter has created a platform. And what Kickstarter does is that platform connects people that want money with people that have money to give. And so that's exactly the way that peer-to-peer lending works. These guys are not lenders. What they're doing is they're connecting borrowers with individuals that want to lend money. They're making those two connected. So now they're taking people that are like you that maybe have $500 you want to invest in a company, And then they're also taking other people that might need $50,000 lent to their business, and they're taking a bunch of you that lend $500, and they're combining that money and pulling it together and giving it to the guy that actually wants 50. Now, a lot of benefits here. One of the benefits is that I will tell you again and again and again, it is way easier to get money for your business from a bunch of individual sources than it is to get that same amount of money from one. So if you want $500,000 for your business, it's really hard to get that from one source, but way easier to get that from 5 or 10 sources. So the more sources you could use to kind of pull together the money you need, the easier it is, because let's be honest, the less that one source has to lose, because they're not fronting a bunch of money. They're fronting a little bit of money combined with other sources to make it a lot of money that you need. So I don't care what you're doing, personal or business lending, it is always easier to pull together a lot of little sources to get the money you need than try to get it from one source. Rule number one you need to know about lending. That's what peer-to-peer lending does. They take private individuals, they pull their money together, and then give it in larger sums to one business. So it's easier to get approved because these sums that they're combining are usually fairly small amounts. So let's dive into the specifics. Here are the ones we need to know about. Prosper, Lending Club. These guys are the biggest in the originals. Upstart, Funding Circle, StreetShares. Those are the 5 in this world that you need to know. I'm going to decode all of them for you. So let's start with Prosper. They were the first peer-to-peer platform in the country. Remember, peer-to-peer means we're getting money from private individuals. Platform means they are just simply a place to pool the money together that then gets lent to you. Now, these guys all have what they call a risk grading scale, meaning they internally use their own algorithms to grade the risk of getting approved. So they're looking at your risk of going 60 days past due within the next 12 months of when you actually apply. So let's look at this. What does determine your biggest risk of going 60 days late in the next 12 months? Recent late payments. So for example, if you want to know what it takes to get approved for these guys, well, when we talk about Prosper, they care most about your risk of going 60 days late in the next 12 months. So what they're looking for is your recent credit issues. If you're recently late on things, if you have recent collections, that can harm your ability to get approved. But if you have a 640 credit score because you have late payments 3, 4, 5 years ago and good payment history since, then you have a good chance of getting approved. So whenever we look at this, they're looking at this risk of going 60 days late in the next 12 months. That means recent late payments is one of the biggest things that they're looking for. Now again, they're going to grade your own risk, and they're going to charge a closing fee of about 0.5% to 5% total. Now, if you are going to invest in Prosper and you want to invest in other businesses, you need to have a minimum of $25,000 invested. So that means they're pulling money together from investors, and their investors are putting in a minimum of $25,000. So Prosper was the original in the space. They're still huge in the peer-to-peer lending space. Jansen Fugate, the guy that teaches loan brokers what they do, is on here. Thanks, Jansen, for joining in. Thanks for your likes and loves. Now, let's dive in and talk about Lending Club. Lending Club is the largest of them. They are 45% of the market. So if you want to know one of the best sources to try, Lending Club is in general one of the biggest and one of the best, okay? I personally have gotten their loans to see how they work, and they are very good. Their process is smooth, it's easy, it's fast, and it's going to require documentation, but again, they have a really good, well-defined process. Now, so far, they've lent $20 billion in business and personal loans. Important here, they and Prosper lend both to businesses and on the personal side in both worlds. Now, they have 36 or 5-year terms, so you can get 36-month or 5-year terms, so 3 to 5-year terms they actually have. Now, you're able to get $1,000 to $35,000 in personal loans, and $500,000 to $300,000 for business loans, and they're going to look at their own score plus your Experian FICO score. That's what they're looking at, is with Experian. So they have their own proprietary model of determining risk, and they combine that with your Experian FICO to determine the grade. And of course, common sense, the worse grade, the higher the interest rate is going to be, because the more likely you are to default. So when we talk about the biggest in the space, here's the biggest in the space. They occupy 45% of the market at Lending Club. Prosper is also the first and one of the biggest peer-to-peer lenders. Both of them offer personal and business loans for you. Lending Club has higher loan amounts up to $300,000 for your business. How much you get will be based on how good your credit is and how much your revenue is. And thanks, guys, for the likes and loves. It lets me know I'm on the right track. Now, Funding Circle only deals with business loans, not personal loans. They're in a bunch of different countries, and they've lent $3 billion total. So combined to Lending Club's $20 billion, they are only a small smidgen of the total amount of money that's being lent in the peer-to-peer lending world. Now, they also lend $25,000 to $500,000 in the United States when it comes to businesses. So you can get a higher loan amount here, up to $500,000 with Funding Circle versus Lending Club, okay? And you're also able to get interest rates of 5.5% to 27.8%. If you were going to invest with them, you need a minimum of $50,000. I like these ranges. Whenever we see interest rates with wide ranges like this, about 5 to 28%, what this tells me is it tells me they deal with low-risk borrowers and they deal with high-risk borrowers. So either way, you have a place with Funding Circle. Now, there's a reason I'm diving into this based on what's going on right now in our world. These guys are all still lending. A lot of places have stopped. A lot of places based on your revenue have stopped. On Deck, the biggest lender in the revenue lending space, has stopped lending. All they're doing is the government PPP loans. Cabbage, stop lending. All they're doing is PPP loans. Lending Circle or Lending Club, PPP loans. A lot of the biggest funding sources out there we've used and relied on to get money are indefinitely on hold with lending money until this whole thing with COVID-19 settles down. These guys aren't. They're still lending money like they always were. So I'm giving you a viable source of getting money for your business that a lot of people don't even know about that can help you get the money that you need to grow. Now, let's dive into a couple others that I think you're going to love. Upstart deals with startup companies, okay? They've done $300 million in loans so far, and here's what's insane. 94% of their loans are paid back on full. They have the highest and best payback rate of any of them, and they deal with startups. So there's something to be said at the fact that startups are performing a lot better than existing companies right now when it comes to peer-to-peer lending. Now, they are looking for young entrepreneurs. That is their niche. Okay, their niche, that is what it is. Young professionals. If you have a college degree, they love you at Upstart, okay? 90% of their borrowers are college graduates. Now, they're going to look at your FICO scores, but here's what's interesting. They're also going to look at your education. So what I'm saying is that if you are young, millennial, if you are a college graduate, Upstart is a great place to go, even if you are a startup business. As I mentioned, lowest default rates in the industry, and they deal with startups. Loans to $35,000. Big change here, guys. Upstart, startup loans to $35,000. Funding Circle loans to $500,000. So Funding Circle, Lending Club, Prosper, better for established businesses. Upstart, great for newer startup businesses, and their interest rate is 4 to 26. So they deal with lower and they deal with higher risk. But here's what's cool. You could actually take your own money and invest as little as $100 in Upstart, and that money can be lent to other entrepreneurs as well. Then we look at StreetShares. Now, I love StreetShares because I'm a military veteran, and they deal with veterans. They were founded by veterans. They wanted a lending program for veterans, and veterans are going to get preferential special treatment. So if you are a military veteran, if you have a military vet-owned business, StreetShares is the way to go. Now, if you were going to invest in them, you can invest with as little as $25 and get a return of about 5% on your money. Pretty cool. Remember, as I told you, there's two things we're going to talk about here. Borrowing money from peer-to-peer lenders and lending money to others through peer-to-peer lenders. With as little as $100, you're investing with Upstart. With as little as $25, you can updo it with StreetShares as well, okay? So pretty cool. And Jansen even gave me an awesome image of a pug saying cool things. I love that. And that's actually Skip did. Thank you, Skip, for sharing that. That's awesome. That's phenomenal. So StreetShares. So you got to be a U.S. citizen, 1 year time in business. Sometimes they'll go as little as 6 months. Okay, you're going to have to be a guarantor for all of them. And again, they're going to do their own credit check, but StreetShares does a soft one, so it doesn't even show as an inquiry on your credit report. 3 to 36 month loans, so loans only to 3 years here, when we were talking about up to 5 years with Lending Club. Why does that matter? Term matters. Term is your payment. So let me tell you one of the most important things I can ever tell you about borrowing money. Interest rates really don't matter. What matters is term. So many people are obsessed with interest rates because we're trained at a young age to ask about interest rates. But what matters most with money is how long the term is. The longer the term, the lower the payment. And interest we can write off and get back on our taxes anywhere. So whenever I'm talking about any kind of loans, the longest term loans are always what you want. That's going to give you the cheapest payments. So when we talk about Lending Club, they'll go as long as 5 years here, 60 months. And when we talk about StreetShares, they're only going to go 3 years. So again, that's okay because they're dealing with lower loan amounts, lines of credit up to $100,000 versus Lending Club that goes again as high as $300,000 and Funding Circle that goes as high as $1 million, okay? So a lot of difference between them. Now, no app fee with them either, so up to $100,000. So those are the 5 main ones that you need to know about when it comes to peer-to-peer lending. So let me do a quick review for all of you. Peer-to-peer lending, way easier to get approved for than big bank loans, way easier and much easier to get approved for than fintech loans. All the online lenders you're trying to get approved with. This is a better way to go because it's easier to get. And right now, they are still free-flowing money. It is still being lent like it always was, unlike a lot of lenders who've pulled back or ceased indefinitely lending because they're so unsure of the existing environment. I'm giving you a solid way to be able to lend money. Now, that being said, here are the biggest sources. Prosper, first in the U.S., they're huge. Again, main point here is that you can actually come in and be able to invest or be able to get interest rates as low as 5% with them. Lending Club, loans to $300,000, terms as long as 5 years. They're the biggest in the space, 45%. Funding Circle, and these guys deal with personal and business loans. Funding Circles, only business loans, but high loan amounts, up to $500,000, deal with low and high risk. Upstart, for startups. We love young business professionals here. We love college graduates here. 90% of their borrowers have college degrees. Loans are smaller, though, because they deal with startups, up to $35,000. You get it. Huge difference between getting a startup loan with Upstart for $35,000 and getting a loan with Funding Circle for $500,000. Big difference here, okay? Interest rates with all these guys are roughly the same, 4 to 5% to 26 to 28%. Then we've got StreetShares that deals with military veterans. They give military veterans preferential treatment, but again, the loan amount's only to $100,000. So StreetShares and Upstart have their own niches, but deal with smaller loan amounts. Funding Circle, Lending Club, Prosper, all higher loan amounts, $200,000 to $500,000 loan amounts. They have a lot more money to lend, $3 billion, $20 billion they've lent compared to $300 million, okay? So you get the difference. So that's how peer-to-peer lending works. Can we help you? Give us a ring if we can. 877-600-2487. We work with every legitimate funding source out there. We can refer you to the right source if you need help. You can get approved at creditsuite.com/get funding as well. We've got a great guide on building your business credit at creditsuite.com/Facebook. Remember, if you call us, here's what happens on the call. We see how fundable your business is and help you fix things that will prevent you from getting all kinds of loans like this by improving your fundability. We also will do a free search with the reporting agencies to see if you're set up with the reporting agencies now. We will get you free reports with Dun & Bradstreet, Equifax, and Experian. We will help you get your business credit reports for free, and we will also determine all the type of money that you're able to qualify for now, all by giving us a call. So if we can help you get money for your business, our number is 877-600-2487. You can get approved at creditsuite.com/get funding. And never forget, you need to build business credit. It helps make you more lendable. It's a great way to get money. creditsuite.com/Facebook. Next Tuesday, I will be diving into everything you need to know about business credit. how business credit works, the tiers of business credit, how to prevent declines, how the credit scores work, the stuff to set up your fundability. That's all coming up next Tuesday. So tune in. We will be live on Facebook going through all of that. So I'm going to wrap up today. Remember, guys, if we can help you, give us a ring at 877-600-2487. We'll help you improve your fundability, build your business credit, and get financing for your business as well. Steve says, great chalkboard work. Anyway, you can post pics of it somewhere. I do need to do that. And you know what? I am going to take pictures. I'm going to get it to my social media. I'm going to do something, Steve. Actually, you just gave me an idea. I'm going to take pictures and get them of our chalkboard on this topic today on social media. Then what else I'm going to do is I'm going to talk to our social media team and make sure that happens every week so you can actually see the chalkboards through picture instead of this shaky video that probably makes you nauseous because my hands, it's like I can't hold it as steady as possible. So great idea, Steve. I love that, and I'm going to make sure that happens. Today, I will get you a picture of the peer-to-peer on Facebook, and moving forward, we will take pictures of our chalkboards and get those on social media. I think that's going to help you as well. So make sure if you want to follow us on social, creditsuite.com, top right of our page, we have a podcast, the Business Credit Financing Show, over 300,000 downloads. Very popular. People listen on the go. We talk all topics, business credit financing, and we have special guests on every week, multiple days that teach you all kinds of things about growing your business. We also have daily tips on LinkedIn, on Instagram, and on Twitter, and we go live on YouTube and Facebook weekly as well. So you can access all of our social links at creditsuite.com. And per Steve's suggestion, I'm going to take a picture of this and get it on our social media page right now. Thanks for tuning in. I'll see you next Tuesday at 2 o'clock Eastern when we talk everything you need to know about business credit so you can build a business credit profile and score for your EIN that's not linked to your personal social. Thanks, everybody. Have a great end of your week, and I will see you next Tuesday here live on Facebook at 2 o'clock Eastern.